Welcome to Investors Hangout. What we used to call till last week Money Hangout is now being called Investors Hangout. It better reflects what we talk about, what we actually do, uh, help you understand investment issues, answer your questions, and so it's not mundane money issue. We don't talk about credit. We don't talk about how to purchase or spend your money wisely. So it's all about investment. So it better reflect what we actually do. So welcome to Investors Hangout. Every week we will be doing what we used to do, which is take your questions, help you understand investment issues. This is brought to you by Birla Sun Life and Value Research. Today we are going to talk about something which we have referred off and on. Every now and then we keep talking about it. It very well fits into, it is very important for us to help you suggest ways which simplifies your investment life. It helps you simplify how you invest, and in an uncomplicated way, in an uncluttered way, and in a manner that you can understand. And this is a question which a lot of people ask me nowadays. Uh, the hybrid funds have come to life. They have become a very prominent part of the investment universe, of the investment landscape. What used to be on the peripheral, nobody used to ask about the balanced fund or the equity income fund or anything. And in a rising market, understandably so, these are not the hottest part of the market. But I think the way people are embracing mutual fund, the way in even the fund companies are acting in a slightly measured way. They are not trying to capitalize on the market rise to aggressively sell something which sells well or is a high performance fund. Everybody is suggesting investors that they should be investing with an understanding. They should be investing in a calibrated way. They should be investing in a manner that they are not disappointed, because most of the time there is absolutely no problem with the kind of investment where investors invest. The problem is the kind of investment that you choose and the expectation that you come up with. Those expectations are never met, because mostly investors come to make investments in an inappropriate investment at a time with a huge expectation, which is a clear recipe for disappointment. And for any investor's need, I'm generally referring to long-term investors. For any investor's need, you need to really mix. You need some mix of equity and debt. What should be the mix? It depends on the time frame. It depends on your temperament. If you are a first time investor, and if you are making a long term investment, but uh, you know you are extremely worried investor, you will be extremely disappointed with a big decline, maybe a 20% decline in 6 months time, and you will be very disappointed. For those investors, you need to really think of a allocation. Everybody needs equity, and every equity investor, any aggressive investor, also needs fixed income, which means that you need to really mix it up. And how to mix it up is a way. This actually presents a question to you, which is how which fund to choose and how to mix it up, which is the most appropriate fund for you. So I would say that broadly, and most investors can actually do it themselves, but the fund route is simpler. Assuming that you think of a dominantly equity portfolio and a nominally fixed income portfolio for your long term. I'm not referring to your fixed income allocation, all the money which investors need to consume in next 2-3 years time, and in a definite time frame. That should definitely be finding its way into fixed income. I'm talking of long term money which should also follow some asset allocation. If you're a long term equity investor, then you should consider 80% into equity, remaining into fixed income, so that you can periodically rebalance. If you are an even more conservative investor, you should think in terms of 50% equity, 50% debt. If you are an extremely conservative investor, then you should consider a small allocation to equity, 20-25% equity, because equity is important even for the extremely conservative long-term investor, because you will not be able to beat inflation. And how to do it with simplicity? There are funds available. The balanced fund, which we keep talking about every now and then, that is the simplest way where long-term investor should be able to participate in equity, get the benefit of active management and periodic rebalancing, without any tax implication, because if you invest 75% into equity, 25% into debt, market goes up by 10%, you want to move your money from equity to fixed income or move your money from fixed income to equity, all those transactions will be liable for taxes. When you invest in a balanced fund, the fund manager does all that for you, and you are not liable for taxes till you hold your fund investment for 1 year and more. So that's a simpler way of doing it, and consider that actively. But balance fund, and there is one, so any investor looking at long-term investment avenue, and that too deriving return from equity with greater stability, should consider a balanced fund. All those investors who are little more conservative, they should consider a 50% allocation to equity and 50% to debt. Consider those equity income funds and other things which are available. There is a set of fund. There are quite a few funds which are actually targeting that allocation, and they are also able to derive the equity treatment for taxation. So consider those equity income fund, equity saving fund. They can come in handy. For the ultra conservative investor, but they are long term investor, they should embrace little risk. They should embrace little risk, and the way to embrace that is consider the growth options of the monthly income plans, the MIPs, where they can actually have 15 to 20% allocation to equity. Uh, they are dominantly debt fund, but the packaging of it, they come in a very neat package. You don't have to worry about it. I wish some of these MIPs had even lower expenses, but the simplicity with which you are able to derive this allocation, with which you are able to invest, derive little more return, and so choose the appropriate fund. These are the three ways to actually achieve an asset allocation: conservative, aggressive, and moderate. Try and do it with one or two funds, and that is all, and these funds can actually fulfill the needs of most investors. This is way to mix it up, and this is way to mix it up with simplicity and convenience, tax efficiency, and this should be the way most investors should start their investing. And for many investors, that is the only thing that they might need.